Good morning and welcome to this Monday, October 26th, 2020 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, it's going to be an interesting morning. We got futures down, coronavirus cases up, and that seems to be the focus this morning. We'll get into all of that in just a minute. Do want to point out anyone who is new to Earnings Beats, I'd love to have you sign up for our free Earnings Beats Digest newsletter. Comes out Mondays, Wednesdays, Fridays in the morning, usually before the market opens. Simply type in your name, email address, hit that subscribe button, and we will get you set up. If you'd like to try our service, I think it's an awesome service. Got a lot of members that are agreeing. You can click on our Join Today button right here. You can check out our portfolios. These are portfolios of 10 equal weighted stocks. They're selected every 90 days. We hold them for the entire 90 days, and then we select 10 new equal weighted stocks for each of these portfolios. We look to put leading stocks and leading industry groups in these portfolios to try to outperform the S&P 500. And I think if you take a look at these results down here in the bottom right-hand corner, you can see we're doing a pretty good job of beating those or beating that benchmark. So again, just click on that Join Today button. We do have a $7 fully refundable $7 30-day trial. So you sign up, pay the $7, we refund it to you within a week, and you can enjoy our service essentially at no cost. All right, let's move on to the market. First of all, on Friday, it wasn't a bad Friday. Things were not looking very good throughout last week. We saw a lot of selling. I know our portfolios actually struggled last week. It was definitely more of a value theme than it was a growth theme. And as a result, many of our portfolio stocks, which are growth oriented, got hit. But it's going to happen from time to time. I mean, the market overall is volatile. We see not only the market go up and down, but we see a lot of rotation back and forth. And last week was certainly a week where professionals, I think, were getting a little bit more cautious. Maybe it was history because we are in the midst still for the next 2 days, today and tomorrow. We're in the midst of the worst historical week of the year on the S&P 500. That dates back to 1950. That's not my opinion. That is fact based on the way the market has traded for the last 70 years. So we've got to get through these next couple of days. I'll go over some numbers with you in a minute, but after we get through Tuesday, it's like all of a sudden the cold water gets turned off and the hot water gets turned on. The numbers are really amazing the way everything just kind of shifts right at the close on October 27th. But again, I'll talk about that in just a minute. See from the numbers here, the Dow Jones Industrial Average finished basically flat, down just a fraction on Friday. The S&P finished up almost 1/3 of 1%. Same goes for the Nasdaq. Mid caps, small caps did a little bit better. Mid caps up almost 2/3 of 1%. Small caps about 1/2 of 1%. But overall, when I look at all of these just quickly, I see uptrend. I see charts moving up from left to right.
Hi,
I see
Tom.
consolidation.
I'm so sorry to interrupt. Can you turn your screen on? It's not
Oh,
sharing.
man, welcome to Monday, right?
Sorry about that.
No, that's perfect. Thank you. Yeah, I don't know why. I just came over and wanted to just talk to everybody with a blank screen. But anyway, I just want to go back real quick. Anybody who is new to Earnings Beats, just make sure you type in the name, email address, hit that subscribe button. That's what I was talking about there. Here are our portfolios. You can check that out when you get a chance. $7 30-day trial, and it's refunded. Talking about these indices here, you can go across the charts and you can just see the uptrend that I was referring to. Sideways consolidation. I mean, we're definitely in a period of consolidation, and that does not end until we break out. Now, the good news is mid caps did break out last week. Small caps tried to break out last week. Maybe we'll get that this week. But the other major indices, the ones that we really follow and the ones that have been leading, especially the Nasdaq, you can see has not broken out above that September high. This is really what I'm looking for. I would say the Nasdaq and the S&P. Eventually, I look for all of them to go higher, but I tend to follow the Nasdaq and the S&P 500 a little bit closer. And so you can see that 12,000, a little above 12,000 on the Nasdaq is one level to watch. Anything above 3,600 eventually on the S&P 500 would represent that breakout. I believe we're going to get it in the fourth quarter, probably sooner rather than later, especially if history is any guide. And again, I'll talk about those numbers in just a minute. Moving on to the sectors, communication services and consumer discretionary led on Friday. So good action there with both up near 1%, just under 1%. Shockingly, energy lagged. We've been watching that now for months, really ever since that June high when energy got up into the mid 40s. It's fallen all the way back down to 30. I mean, it's unbelievable to think, even after everything we've been through this year, that energy would lose another 30% from where it was in June. But that's the reality. As far as our individual groups go, industry groups, brewers, I think it was Sam's Beer on Friday that came out with a huge number and gapped up, and the whole brewer group made a nice break. This is a nice looking chart now. There are a lot of areas that struggled, and back in June we made a move, you can see, and then many areas have had a tough time getting back through that June high. Don't count brewers in that group. Brewers actually making the breakout here back in July and August, consolidated with the rest of the market, but clearly broke out on Friday. Really good action there. Business training and so forth, that group trying to get through the August high that it set. So it had that high back in late May, early June, went through it in August, and now we're trying to get back through that. Let's watch to see if it can hold that 20-day moving average. That we went just below it on the close on Friday. You can see 131.76 is the 20-day moving average, 131.41. And I'm in favor of seeing more and more groups leading. If there's one big problem I do see with this particular chart, though, it's that AD line. Even when the action turned bullish at the end of September and into the first couple weeks of October, the AD line kept going down. So it's just, I wouldn't use the AD line. I get this question a lot. I wouldn't use the AD line as my primary indicator. I wouldn't look at this and say, oh, I'm going to go short this group because the AD line's breaking down. That's not how I use it. But I do use it as a confirmation tool. When you see, for instance, the Nasdaq go up and set a high to the upside, you can see the AD line going up with it. And then we pull back, and while we're pulling back, the AD line just stays flat to the upside. That to me is more of a bullish indication. It's not supporting this move to the downside. And then as soon as we get a little move to the upside, we set a new high in the AD line. That is just it's a secondary indicator, but it's one that I think has carried a lot of meaning in 2020, more so than other years. At least I had never recognized it as being that important of an indicator, but I think it has been in 2020. I think it's really helped focus on the areas that have been truly strong and other areas where I'm going to say maybe truly manipulated and not so much strong. They would gap up at times, but never really got carry, or follow through. And I think the AD line has helped us with that. So I would just like to see when these areas of the market advance, I'd really like to see that AD line moving up. And look at energy. It's a perfect example. Energy has been just giving us horrible signals throughout much of 2020. And we're at a 52-week low to go with the price action that's been going down. So it's just not good. All right, let's move on. 10-year Treasury yield. We do have September new home sales coming out later this morning. The expectation is for 1,016,000 units. August was 1,011,000 units, so we're looking for a slight increase there so far. And let me get a quick update, see where we are. Yeah, we're down about 3 basis points in the 10-year Treasury yield, but we are through 0.8%, which is where we had struggled earlier in October. Really, the only thing on the chart that now we're staring at overhead is this June high, where we got a little bit into that 0.90 to 0.95 area. I believe we're going to head there to the downside. Watch that rising 20-day moving average. To the upside, watch that June high, and we'll see which gives. But I do like, and I've been pointing this out, the PPO in positive territory now for over 2 months, close to 3 months. I think that's bullish. We hadn't seen that throughout 2020. So it seems like momentum is building to the upside, and I'm not looking for a huge move higher in interest rates, but I do think that we could see some action, especially if earnings continue to be strong. I could see money rotating out of bonds and chasing stock prices higher. That's what I think is going to happen in the fourth quarter and into 2021. And I think that you're going to see that reflected in higher Treasury yields in the near term. There was a news story out this morning. Dunkin', DNKN, they confirmed that they've had preliminary discussions to be acquired by Inspired Brands. And if you ever want to check out a stock or some of your stocks or a bunch of stocks pre-market, go up and check this symbol summary here on the drop down. Don't use a sharp chart. Pre-market, post-market, use symbol summary, and then type in this case Dunkin', and we'll see what the stock's doing pre-market. You can see it's up 18% on the news, and stock's been under accumulation for a while. Now we could say it's earnings. We could also say maybe word had leaked. Maybe there were some folks out there thinking that maybe Dunkin' was going to get acquired. I don't know, but stock is up 18% in pre-market. AstraZeneca announced that, they said that their vaccine triggers an immune response among adults. Stock getting a little bit of a lift, but some of these stocks that have been in the news with this coronavirus vaccine have been drifting lower. I mean, I've seen it among some of the best. Regeneron, which is one of the companies that I really liked, is another one that's been trending lower. Even though they came out some good news, of course, with President Trump came down with the coronavirus. He took the antibody cocktail that's manufactured by Regeneron Pharmaceuticals. That's where this gap up came in at the beginning of October. We went right back and gave back all of that. And now the stock's down another $7 today. I mean, these stocks just seem like a lot of it was priced in. And now that we're getting closer and closer to a vaccine, it's almost like market doesn't care anymore. That a lot of that good news was already built into the prices. It's going to be very interesting when we do finally get an FDA approved vaccine, what kind of response the company gets, and does it stick? We'll probably get a positive response, but is it something that sticks? Do we get a breakout, or has it already been priced in? All right, let's keep moving. Talking technically. First of all, this is a 3-month hourly chart on the S&P 500. It's one that I've been watching. It's one I've been writing about in the daily market report. And if you annotate, and this is what I've been watching, first of all, you see where we closed back here on September 5th, and then we gapped down on September 8th, and we came back up, couldn't get through this 34.25 area, went to a new low, couldn't get through 34.25, went to a new low, came all the way back up, trended higher, couldn't get through 34.25. This time did not go to a new low, instead held this uptrend and then broke out above 34.25. Well, in this weakness, we came down to about 34.40 here. We bounced, then we hit 34.25. We held, bounced again, 34.25. Looks like a little false breakdown there. A little lower low. That always gets me a little bit excited when I see a lower low and then we hold support. We've seen that on big long-term charts. We saw it in 2008, below, or 2009 when we went below the earlier lows and, came roaring back. I mean, we've seen it on long-term charts. We see it on intermediate charts. We should see it on short-term charts. So the action after, potentially breaking down there was pretty bullish, but we finished 34.65. We got today and tomorrow to get through this bearish historical period. And we do see futures down this morning about 1%, at least last time I looked. So that would mean about 35 points on the S&P 500, which would take us back down to about 34.30. So at the open, we're going to be testing this level again. Do we get what appears to be a breakdown followed by maybe some bullishness later on? I don't know. Let me read you some numbers here. Let me get my other spreadsheet up on my other computer so I can read you some numbers. Okay, so here we are right now in this bearish period. I'm going to read you first the annualized returns on a historical basis for every calendar day from October 22nd to November 5th. So October 22nd, starting last week, through October 27th, I reported as a bearish period. And again, this isn't just me saying I'm looking at a chart and I think it's going to, market's going to pull back. I'm talking about the history of the stock market. October 22nd, the annualized return on October 22nd of every year dating back to 1950, minus 96.42%. The 23rd, minus 7.03%. The 24th, minus 39.18%. The 25th, minus 48.74%. The 26th, minus 47.15%. The 27th, minus 18.32%. Every day negative, some days more so than others. But my point here is throughout the year, you'll see one day that's minus 60%. And then the next day is plus 72%. It's like, okay, they offset. But when you see an entire week like this, it's very unusual. And it just shows you that historically, there's something that tends to take place this time of the year. Call it after earnings, call it October. You know, October's got a bad name. Of course, Black Monday. That was October 19th. That was actually a little bit before this period starts. October 19th, 1987, for those of you remembering that day. But those were the negative returns. Keep in mind, the S&P 500 has averaged going up about 9% a year for the last 70 years. So if every day was created equal, it would be really boring, but every day should have an annualized return of about 9%. Every one of those not only was not 9%, none of them were positive, all of them were negative, many of them significantly negative. So there's clearly historical underperformance that takes place during the week we're in right now through tomorrow's close. But as I mentioned at the open, it's like flipping the faucet from cold to hot. Starting on Wednesday of this week, which is October 28th, let me read you the annualized returns from the 28th through November 5th. 28th, plus 134.86%. 29th, plus 73.47%. The 30th, plus 63.05%. 31st, plus 19.81%. November 1st, plus 45.47%. November 2nd, plus 81.20%. November 3rd, plus 93.95%. November 4th, plus 34.38%. November 5th, plus 63.59%. We literally go from the worst week of the year to the best 9-day period. We go, and it just ends, and then the other one just starts right on the heels of it. So I'm looking at these charts with just the knowledge of what takes place historically in the back of my mind. Again, does this mean that tomorrow afternoon at the close, I would just rush in and, maybe get a second on my house and, put it all in the QQQ or the spider? No, I'm not saying that at all. Please don't misinterpret what I'm saying. I'm just reporting the facts. This is what's happened historically. Will it happen again this year? I don't know. I do know that over the last 70 years, when we close on the 27th, we go higher from October 27th to January 18th, 61 of the last 70 years. So only 9 times in the last 70 years, which is just a little bit more than 10% of the time, we actually go lower the next 2 years, or next 2 months and 20 days. And so I kind of like the odds that this market's going higher. I believe we're in a secular bull market anyway. If you go back and look at some of these periods where we actually went against the historical grain, we were in bear markets. Not every time, but many times we were actually in bear markets. So do with it what you want. But, when I look at these numbers and I look at the charts, I'm watching 34.25. I mean, if over the next 2 days we go below 34.25 and then we come back up above and start to break out above these hourly moving averages, that to me is going to be a sign that we are starting the next leg up to the upside. And I get a lot of questions about the election. I can only tell you that I've done research on, different parties in the White House and who's in control of the Senate and the House and so forth. And I would say my conclusion is that it doesn't matter who's in the White House. Historically, the stock market has gone higher with both parties being in the White House. I know that, and I'm not trying to pick sides one way or the other, but I know there's this thing about Republicans lower taxes and, therefore it's much better for the stock market. I would say looking back at history, that's not the case at all. So I'm not telling anybody how to vote, but that wouldn't be one of my considerations when I go to the poll about the stock market. Now, what the stock market doesn't like, from my research, is when one party is in control of everything. So when you've got either the Democrats or the Republicans in the White House and leading the Senate and the House. And I mean, my theory is that we've got, 80% of our country lives in the middle. 10% far left, 10% far right, maybe a higher percentage, I don't know. But I don't know that having one party in charge of everything is good. That's the only political comment you're going to hear from me. Vote your conscience. That's all I'm going to say. Anyhow, as we go forward, I would say that, watch this 34.25 level on the S&P 500. The Nasdaq has got a similar look to it. Let me annotate this for you as well. I mean, if you look at the highs, they're not exactly the same, but here was that gap down on September 8th. So we didn't quite get up there and test it here, but we got close. Here we did test it in an uptrend, broke through, and we went a little bit below 11,600 last week, but then we rallied. We're going to probably be back down there testing it again today. We'll see. But I'm going to say, 11,575, something like that. I'd be watching. And if we go down below it, just be cautious. If we come back up, get through it, especially get through these hourly moving averages, I think I would start to turn much more bullish, knowing what we know. So if you're worried about the election and we start to break down this week, just stay away. I would say let the market tell you when it's safe to get back in. When we get back through those moving averages, the 20 and the 50, and we start to make some progress there, that's when I would be a little bit more inclined to be bullish going forward. On the daily chart, we pull up the Nasdaq. We're right at the 20-day moving average. We're going to gap below it today. The S&P 500 had bounced off of the 20-day. We're going to probably be right back down, maybe a little even bit, 20 days, 34. We're going to be almost right on it probably at the open. Let's see what the Spider is trading at pre-market. Yeah, it's down 1%. We're going to be almost right on that 20-day to start. And I'll look at the others. QQQ, a little bit better. Diamond, not so much, down a little over 1%. Small caps down the most. So at least early on, it looks like maybe we're getting a little bit of rotation back toward the Nasdaq on a relative basis, and that was not the case last week. We had some struggles in that area in terms of rotation. So let's see what happens. We got a ton. This is a big earnings week. Huge, not only in terms of numbers, but some of the companies that will be reporting. We do have later this week, we've got Microsoft reporting tomorrow, Apple, Amazon, Google, and Facebook all reporting Thursday. So, and they're all coming out in the bullish historical time. Microsoft starts it off Tuesday after the close. This is going to be a really interesting week, especially from a timing standpoint. Does Microsoft kick it off with a bang? We're going to find out. All right, what else do we have for today? Maybe just a quick look. I mean, here you can see the technology group. I still look at this on a relative basis. This is the XLK relative to the S&P 500. So we've been seeing some of the momentum weaken, which is fine. I mean, we're still way in positive territory. That's the really big thing for me is, as we've been going up, it just tells me that our relative momentum isn't as strong as it was, but we're still going up. We still have relative momentum that's positive. So as long as we're consolidating and we continue to consolidate here over, maybe these next couple of days, who knows, maybe even, further into the fourth quarter, we'll see. But a breakout is unmistakable. So watch to see if we take out that August high on this relative chart. I still believe consumer discretionary, one of the best areas. We've barely even pulled back, even with the shift and the rotation and the consolidation in the market. Look at consumer discretionary stocks. I can tell you that does not look like a bear market to me. It does not look like a bear market is anywhere in our future. There's no way Wall Street would be pouring their money into consumer discretionary stocks if we were getting ready to go into some, deep recession or a bear market or anything like that. So I literally just chuckle when I see anyone writing about bear markets and how markets overpriced and everything else. Wall Street completely disagrees, and I'm going to go with Wall Street. All right, chart lists. I do like to look at these chart lists. Oh, I wanted to show, there was a couple of groups in the technology area, a couple of industry groups. Obviously, semiconductors doing well. Software has been doing well, even though it's been consolidating. And once again, relative momentum's been slowing. I wouldn't be surprised to see Microsoft get things kicked off this week, maybe moving back to the upside. We got Twilio coming out after the bell tonight. The market loves Twilio. That's all I can tell you. I don't know what kind of report we're going to get. I would suspect it's going to be a strong one just based on the way it's trading. That doesn't always mean we gap higher. We could have a great report and the stock could still fall. We've seen that plenty of times. Saw that with the Tractor Supply Company. But looking at the charts, I think software remains a leading group. And so look for some of these leading stocks within the group to really help out. But here's a group. We've got electronic equipment index making a break above its 20 and 50. We've seen this before, but at least this time we're seeing that relative PPO break above the center line. That did not happen back in the initial thrust. I think it would really be bullish to take out this relative high. And this is another area in technology that could be or could start to add to the bullishness in this sector. Computer hardware is pulled back a little bit, but again, very much a leader, has been for a long time. It's okay to pull back on a relative basis for a period of time during consolidation. The one group, though, that I really like what's going on here in technology is the electrical components and equipment index. This is really looking bullish to me, not only here on this relative chart and doing what it's doing. I mean, look at that relative PPO. Normally, you don't get to a relative PPO of almost 2 when you're in a downtrend. I mean, we've seen some of these moves to the upside before that have been head fakes, but we don't see this kind of momentum in those prior head fakes. This one looks to me like the real deal. And after sideways, this is the absolute chart on this group. I mean, we really struggled at around 400. Well, we went right through that. So we're getting the absolute breakout, the relative strength. Look at the 20 coming up through the 50. We never saw that before. This is a group that I think, you need to be at least conscious of. And what I do is I like to go into, say, our strong earnings chart list, and you can just type in electrical components and see if there's anything on here. Electrical components, there you are. Now, Scooter's bad because these stocks have been underperforming for a while, but they're starting to strengthen. So this is one way to look at them. Now, I don't know if this is going to be, these would be the stocks that I would look at or not. We could pull the charts up and take a look and see what's going on here. Yeah, we need some work here. I mean, we broke down below what should have been pretty good support, did so on big volume. I mean, if we get back through 68, that would be bullish on this chart. But until then, probably be a little careful. Let's go into COMM, which is Comscope. Yeah, another one not really doing much, but you can see this triple top up here around 11.5. We're all the way down just above 9.5, so it's got work to do. I don't know that I'd be a huge fan. I was kind of watching when we got that breakout in August with the earnings report. It pulled back, did not even hold gap support, which I would have expected. So there's mixed signals here. But the group has been in a downtrend for a while. A stock like this, if it breaks out, I think would be really bullish with the group doing what it's doing. Now, the other thing you can do is simply go into the scooters, this scooter report. So this is back on your dashboard, and then type in electrical components. All right. So now we've got two that are much better, 85 and 81 on the scooter in the large cap area. So look at, and you can see we got a much better stock here, although the AD line a little bit bothersome. And then Amphenol, APH, looking good, but again, AD line not great. But we can go back and we can throw in mid caps. And I tell you what, to wrap up, let's take a look at the three top with some good volume. So I'm going to take a look at Flex. Let's see, Flex. I'll take a look at Arrow, ARW, and then Hubble. We'll take a look at those three and just see what's going on. So first, Flex. And I think Flex came out with some news last week that they were thinking about spinning off a company. So it always makes me a little bit nervous when a company announces a possible spinoff, because what happens if sometimes you get these, they'll set up a committee or something to go find out, if they can sell, and then they come back and it's like, well, we decided not to do it. And then all of a sudden you lose everything you gained one day. I just think the risk is so great to hold overnight when a stock comes out and does that. I'd rather have a company go up because of earnings. That's something that can be very sustainable. A possible takeout or takeover or spin off or whatever. It's nice if you own stock and it comes out with that kind of news, but I'd be tempted to take it. And if you notice, all 3 of these days with the big volume, first 3 days, look at those long tails to the top side. So the stock's going up, but there's sellers coming in the afternoon. And look at the AD line dropping. It always makes me nervous. I don't know. This one is one I probably would not be overly excited about, even though technically it does look pretty good. The next one is Arrow. So the second of your 3 you must see. Let's take a look at Arrow. Arrow Electronics. Now I like this one a lot better. Look at it's up here trying to get through this overhead resistance from December and January. It still has the same issues with the AD line. Seems like this whole group has issues with the AD line. So what I'd really like to see is a very solid bullish candle where you gap up, clear the overhead resistance, and continue see buying throughout the day on heavy volume and see a big spike in the AD line. That would be my wish list for ARW. And then the last one, let's take a look at Hubble. Hubble made the breakout and the volume picked up. Now this one it's probably okay. Average volume about 200,000. I would be watching to see if we get some follow through. Now the market has just opened, so we can see Hubble right now is down about 1% today, but we did get a breakout. I would watch 2 levels. I think this just below 150 would be an initial price support level. And then a lot of times when I get a breakout, my trading strategy was, okay, broke out. If I close below 149, I'm going to get out, or whatever that high candle body was. I can tell you what it was. 149.43. So probably 10 years ago, I would have bought the stock on a breakout, and if it closed back below 149.43, I'd get out. And I used to do that, and I'd get whipsawed. And then I realized that a lot of times the stock would go down, it would fail in the breakout and go down, test its 20-day, and then take off. And it does appear to be in this nice uptrend. So I think a pullback back to about that 149, 43 level, 149.50, 149.75, really anything around that area could be a partial entry. And then 20-day moving average, if it did happen to get down to that level, would be the second entry. Otherwise, my second entry would probably be on another breakout. So that's the way I would play a stock like this. If I like the group, I like what's going on in the group. I'm getting a stock that's breaking out, probably is a relative leader over time versus its peers, given the fact that it's breaking out. Actually, it's not. That's kind of interesting. Well, I guess the group going up since that March low has actually been moving up faster than the stock. But it is starting to show some relative strength. Volume has picked up. I would want to see that continue. I think even further confirmation would be maybe breaking to about a 5-month relative high, above 0.385, maybe somewhere in there. You're kind of getting a live interpretation of how I look at charts. I kind of say, well, I really like this one. And I look at something else. Well, maybe not. I need to see it do this, or I need to see it do that. But one thing I would say is if I got in on these pullbacks and it didn't hold the 20-day moving average, this right here is beating me over the head to make sure that I don't make excuses, that I take my loss and move on. I'm not going to go with a stock that's been lagging the entire group. If it can't hold, when the group's breaking out and it can't hold a 20-day moving average, I'll find something else in the group. I don't want to be married to that stock. All right, let's get a quick update on the market, and we'll wrap up for today. Again, a lot of earnings coming out this week, so be careful. Make sure you are, you know which stocks you own when they report. We try to keep our members up to date as much as we can on portfolio stocks and so forth. In the daily market report, I give you a list of stocks, usually over 10 billion in market cap, that will be reporting. But I make a mistake sometimes. I get my information from Zacks. They make mistakes sometimes. Last week, I got a few emails from the weekly portfolio report saying Amazon doesn't report. I had put them in there as reporting last week because Zacks had it in there. Well, Zacks later took it down, and then they now have it in there for this Thursday. But I don't go in and check Zacks on every earnings report they give me. So anytime you see that your company, might be reporting earnings, double check, or even if you don't see it reporting, check to make sure that it won't be reporting. But currently, you can see that the Dow and the S&P definitely getting hit harder than the Nasdaq at the open. So are small caps and mid caps. I don't know if this is maybe the start back of rotation. We saw the opposite last week. We saw growth versus value, or we saw value versus growth. I'll give you this one last chart to wrap up on. And if I go in here and I'm going to do an hourly chart, and we'll do a solid line, get rid of the volume, and let's go 6 months. So here is, and you can see really since the beginning, or middle of the month, that this ratio has been going down, but today it's up a little bit from 181 to 182. Is it breaking this downtrend? I was watching this double bottom right here, because if that breaks, then that could lead to some additional selling, especially among growth stocks. If it holds, we could be seeing bottoms on many of these growth stocks as we move into a much more bullish time of the year. So this is always one that I've been watching. And if you look at this and you also look at, say, the QQQ versus the spider, you'll see a similar. I mean, the charts almost look identical. Where there's our near double bottom. Now we're bouncing today. But growth versus value, another way to look at it is NASDAQ versus S&P 500. So let's keep an eye on these two charts as we go throughout this week as well. If we go down, but these relative ratios are going up, I think that's bullish, because that's just institutions using weakness as an opportunity to rotate from, the value stocks maybe that they were trading last week into more growth-oriented stocks, which they may want to hold going into the balance of the fourth quarter and throughout some of these earnings reports. So those will be a couple things to keep in mind. All right, that is it for today. Appreciate everybody stopping by. Sorry at the beginning when I didn't give you the screen. I don't know. After a weekend, I guess I just wasn't back in the swing of things just yet. Anyhow, have a great week, rest of your week. Good luck on earnings if you're holding into them. And be back tomorrow over at Stock Charts for your next Trading Places Live. Take care. Happy trading.